Hi, everyone. Sandra here with the Mortgage Center. We are just about to get started for um, the next webinar that the Mortgage Center is hosting. As for the realtors that are joining us today, I just wanted to thank you guys for GDAR allowing us to be a part of your Platinum Sponsorship Program. And we have been doing that consecutively for I don't know how many years. Probably, oh gosh, maybe 10 or 15 years, and we just love working with realtors. And the reason for that is we find when the realtor and the mortgage broker are communicating, it always is it always ends up for the benefit of the person who's buying or selling, because when the mortgage broker knows what the realtor is doing, and when the realtor knows how the financing is going to come together, we usually get a really happy buyer and seller. Um, and again, thanks to GDAR for allowing us to be part of your Platinum Sponsorship Program. And we love doing these webinars too, because we love sharing information with real estate agents and our clients alike. And some of the comments that we often get from clients are like, wow, I never knew that. My bank didn't explain that to me. So today we're just going to get started because I want to honor, we have over just almost 40 people registered for today's webinar. So we're just going to get started to honor those folks who have joined us on time, but we will also be happy for anybody who wants to join us and is running a little bit behind. So today we're going to spend the next 10 to 15 minutes talking a little bit about the mortgage market and what's to come for the next 4 to 6 months. And, we help hundreds of people at our office. So we have a really good perspective on what's happening with the local, not only real estate market, but also what's happening with financing and what people's sentiments are. And I'm going to show you a lot of graphs, which I know you will love, and I'm going to just talk to you a little bit about them. So I wanted to talk a little bit about GDP and, what's happening with that. And as you may know, the GDP report came in recently much softer than expected. So the growth, it was expected to be 1.3% annualized gain, but it actually came in at 0.2. So now what we've actually seen is negative numbers in GDP growth, negative numbers in the last 2 or 3 quarters. And stats are showing that the GDP is going to be flat. So there's lots of signs that the Bank of Canada's rates are cooling. We actually just saw over just a little while ago at the beginning of September that the Bank of Canada left its overnight lending rate. And remember, the overnight lending rate affects the prime rate, which impacts variable rate mortgages. So, that was sort of a relief for those folks who had variable rate mortgages, who saw sort of significant rate increase in the last year and a half and significant payment increases. However, the Bank of Canada is still cautioning that they are in fiscal tightening mode. So real household spending has slowed, and it's been the weakest that we've seen in GDP growth. You can kind of see that in the last 2 years. Building construction fell by 8% year over year, and renovation expenditures fell also by 4%. So decrease in consumption and GDP, you can see here that, the blue lines or the blue bars show it. Real household consumer expenditures per capita have significantly decreased, and you kind of see it right here. And then real GDP per capita, you see it here at the sort of the last little bit, is that it's come down. So economy is seeing declines in growth on a per capita basis. And it's really only Canada's massive population boom, which we think is temporary, that's keeping Canada from a formal recession. And, there's been some grumblings now that, with all of this migration, what sort of the quality of life, and like our wages really keeping up with that. So that's what we're seeing is real household consumption and expenditures per capita are decreasing. So people are pulling back on what they're spending. And, it makes sense because over the course of the pandemic, what we've seen and what economists were seeing is there was like an accumulation of wealth and savings. But as prices and mortgage payments have gone up, especially for those folks who had variable rate mortgages, that all of that savings that they had during the pandemic because they weren't going anywhere, they were also getting some income supplements, that is now starting to wane. So consumers, and that's the main driver of GDP, consumer spending, is starting to wane. So kind of the good news, you'll hear sort of a lot of like mixed messages in my presentation today. And the reason for that is there's a lot of volatility and uncertainty. So Edge Analytics is an organization that we follow. And I just want to give credit to, these are some of the graphs that they've provided us. And this is a really interesting graph because what it shows is the chance of the Bank of Canada rate hitting 5.5 and a quarter. So the Bank of Canada's overnight lending rate today is 5%. And this graph shows the chance of the Bank of Canada rate hitting 5.25. Okay, and so the orange graph shows, well, these were the expectations that economists were saying in August 2023, that the percent chance that the Bank of Canada was going to increase its interest rate, right? And then come September, when the Bank of Canada obviously sort of said that they weren't increasing their overnight lending rate, that chance of the Bank of Canada increasing the overnight lending rate actually subsided. So, there are some economists still predicting that we are going to see another rate increase for the overnight lending rate before the end of the year. However, the likelihood of that happening is fairly low, but it's still 40%. Okay. There was back in July, and I mean, volatility and inflation still continues to be a problem. So there was an inflation surprise in July that led to some volatility with interest rates. And I'm going to talk to you a little bit about that. Um, Inflation is set to reaccelerate due to some challenging base effects of inflation, like people, buying power for consumers is not as much as they um, expected. Like the government is starting to talk about stepping in to help alleviate some of the costs for groceries and stuff like that, especially for lower income Canadians. But the expectation for more inflation is quite volatile. Uh, Remember, the key measure of inflation is the consumer price index. And this is the graph that shows you sort of the consumer price index and what it's been sort of since 2000. If, for example, if consumer price rises by 0.2% each month for the remainder of the year, we'll end up with an inflation rate of over 4%. And remember, the Bank of Canada wants the consumer inflation rate to be at about 2%. So it is quite volatile times. And what we're seeing is that when sort of there's the volatility, it's reflected in the bond market and the bond yields. So again, right up until now, I've talked a little bit about the overnight lending rate, which impacts variable rate mortgages and lines of credit, secured lines of credit, credit cards. But the bond market, which is based on it's a leading indicator. It's forecasting, well, what's going to happen with inflation in the future, but it also impacts fixed rate mortgages. So you can see here, sort of, we did have sort of a little glimmer of hope back at the end of August, where the bond yields actually came down. And we saw a 5-year fixed rate mortgages just for a short period of time being close to like 5.25, 5.5%. But um, right now, we track this on a daily basis. So when I see the bond yields going up, I know that fixed rate mortgages will increase probably in 2 or 3 years. Now, this is right from the Bank of Canada website, and it's the 5-year bond yields. Now, I have had a lot of inquiries about 3 or 4 year fixed rate mortgages, but they are higher currently than the 5-year fixed rate mortgages. And what we've been recommending to consume clients is, well, if you're going to do a 3 or 4 year fixed rate, you may want to choose a 5-year variable, because again, um, the rates tend to be very similar with a 5-year variable or a 3 or 4 year fixed rate mortgage. And then you'll get the benefit of when the overnight lending rate comes down. So just something that we're seeing in our office. I am getting more and more inquiries though from people who would like to choose variable rate mortgages. They're saying, well, what about a variable rate mortgage instead of a fixed rate? So very interesting times. What we've also seen is that deeply discounted mortgage rates have increased by almost 10 basis points in the last 3 weeks. And it's really the result of this, where the bond yields are going up. And then again, we're starting to see fixed rate mortgages going up as well. Variable rate mortgages are kind of, you can see they're starting to plateau a little bit, and that's for the fact that the Bank of Canada hasn't changed its overnight lending rate. So what we might start to see probably latter second or third quarter, at least what economists are telling us, second or third quarter of 2024, where we might see some decreases in the prime rate. But affordability is obviously an issue. So with higher mortgage rates are really putting pressure on affordability. So for example, the monthly average mortgage payment for a typical Canadian home has risen by 15% since March 2023. However, what we've been seeing in our office is that many first-time home buyers with good income, decent down payment, and good credit history are now kind of taking the opportunity to purchase a home, and they may actually be choosing a variable rate mortgage. I just did a check with a customer yesterday who is a first-time home buyer, and their budget was under 600,000, and they were okay to buy a condo. And I was actually surprised at the number of properties that were listed as condos in the Guelph and surrounding area. So um, that's one of the things that we're seeing again is affordability is becoming an issue. But we have many buyers that are in an excellent position who have good income and good credit and have a decent down payment, and many of them are getting gifts or an early inheritance from a family member that are moving forward and just getting into the housing market and often choosing variable rate mortgages. I did want to mention to you, I'll do a little sidebar here. Now, if you have any borrowers or buyers that are purchasing something under a million and can afford a 25-year amortization, this is where the interest rates are the best right now. So purchases under a million and those borrowers that can afford a 25-year amortization, we're actually seeing the best rates on the market right now compared to purchases over 1 million and people who require 30-year amortizations to debt service their household. So if you do have listings that are over a million, you're likely starting to see a lag. And I certainly am seeing that. We did have a few clients who put offers on properties who were over a million without a sale of home. So they were selling for over a million and they were buying for over a million, and they purchased a property for over a million, but then they weren't able to sell their house. So now we're doing some complicated financing and very costly financing to help them close on their purchase. And, it is a very expensive endeavor. So affordability is becoming an issue. If you have clients who purchased 2 or 3 years ago and required alternative financing, they are probably the most at risk for having issues with mortgage repayment because if they were marginal a couple of years ago and if their financial situation hasn't changed and they were purchasing sort of at the top end of their budget, when that 1 or 2 year mortgage comes up for renewal, and oftentimes these shorter term mortgages are these alternative mortgages are shorter terms, they will have issues with affordability. I'm getting many calls from people who purchased properties a couple of years ago, had alternative financing, and weren't counseled properly on, sort of impacts of interest rate fluctuations, and now are finding a hard time making ends meet. Demand for, you can see this is sort of an interesting graph. And again, I want to credit this to Edge Analytics. What this does, let's look at these assumptions. So it's the composite HPI. You guys all know what that is because you're realtors. Seasonally adjusted for a dual income family at 80% loan to value on a 25-year amortization with a fully discounted mortgage. So you can see here in British Columbia, and I would argue that for Guelph and the surrounding areas, what we're seeing is that probably between 38 and 40% of people's pre-tax household income is just going to carry the mortgage. And I am actually seeing that when I'm meeting with people and discussing mortgage needs, and the way that they're looking at it, if it's a dual income family, well, one of the partners in the relationship or the purchase, their income is solely going to go toward making the mortgage payments and hopefully being able to cover the property taxes and maybe the condo fees. And then the other person is going to take care of all of the day-to-day living expenses like grocery, car, vehicle. So I don't believe that that's a sustainable way to look at things. But what I'm finding too is a lot of buyer expectations. They want that detached house instead of, and I think you as realtors probably see that. So just to kind of wrap up for the last couple of minutes, these are some of the recommendations for your clients, and we'd like to pass this along to you. We are still recommending, obviously, that people get pre-approved, but if rates right now are unusually high, getting pre-approved not only secures your interest rate, but it also helps the buyers set themselves up for success for and a budget. So what we're telling our pre-approvals and our buyers is, let's still get you pre-approved. Once you're pre-approved, what we do at our office is on a weekly basis, we check in with the pre-approvals. If the rates come down, we relock in those rates automatically for another 120 days. So please encourage your buyers to still get pre-approved because it helps set them up for success, because it helps determine their budget. As I had mentioned for point number 2, purchases at less than $1 million have the best rates, especially if borrowers can afford a 25-year amortization. So we're still getting some interest rates in the mid fives right now for purchases under $1 million. For variable rate mortgages, clients can expect prime minus 0.9 or prime minus 1. We do have many clients who are buying and selling. We always recommend to sort of go through a buy sell analysis. I'm not sure if any of you have joined us for our buy sell presentation, but we have an excellent spreadsheet. I'm happy to share that with you, that goes through a scenario of, like, if you sell your home and includes all the real estate commission and all the costs, what you're left over with after you pay off all your debt, and then how that can then become the down payment for the next house. So even if you are porting the mortgage, get pre-approved, because oftentimes when we can port most mortgages, even if they're with banks, because we do mortgages for TD and Scotia, for example, we can help determine whether or not it makes sense to port that mortgage or get a completely new mortgage. I did want to mention we do have several clients, or I do often get calls for people who have variable rate mortgages. Most variable rate mortgages aren't portable. So either the client has to pay the penalty or lock in on the rate and then port the mortgage. And then I cannot emphasize enough about how important income documentation is and clarification around employment is. So we have many buyers, like we don't typically meet with clients unless we get a basic mortgage application and some basic income information. It's really important as you as realtors to set the expectation that when you're going to ask for financing, make sure you've got your income documents together because we will be asking for them upfront. So that wraps up today's webinar. As I said, we love working with realtors. How do you get in touch with us? Well, I always appreciate any referrals that I get from clients. The best way to handle it is obviously call me if you want to review the scenario, or you can just simply do an email introduction and then I'll take it from there. One of the really great things about working with us, we always ask for permission from your clients to share the consultation with you as a realtor, just so you know what's happening. So again, we love working with realtors. This wraps up our webinar for today. And this webinar will be posted on our YouTube page. If you haven't already gone there, we've got hundreds of really great videos. There's a whole list curated for realtors, and the YouTube channel is the Mortgage Center Guelph. Thank you so much, and have a great day.